My name is Steve Doran, property investor, author and coach. And I want to have a quick chat with you about the difference between good debt and bad debt. Because I know as a child growing up that I was always told that all debt is bad. And what I've come to realize as I've got older and I've got more heavily involved in property investment is that that's just really not necessarily the case. So I want to make a quick distinction between what is good debt and what is bad debt. And I'm going to say that bad debt is anything that costs you money or loses money. So for example, if you buy a depreciating asset, such as a television, that's generally going to be bad debt. Or good debt, something that increases in value or goes up over time, or perhaps gives you some sort of revenue or income. So good debt and bad debt. Now, an example of bad debt would be getting yourself a credit card, going out on a shopping spree and buying a load of clothes. That's going to generally run on quite a high interest anyway, so please don't do that. But good debt would be getting a mortgage, for example, on an investment property. Now, I'm not just saying go and get a load of investment property without knowing what you're doing. You definitely need the education and support, because you're going to need to do things like stress test your property to make sure that when you get a mortgage on a property that you're going to be in a positive cash flow. You don't want to get a buy-to-let property, for example, and end up with your mortgage not covering your rent not covering the mortgage. So what you want to do is make sure you're stress testing. So how would you stress test something? You're going to have a look at what's the current interest rate, and obviously that changes depending on when you're watching this video, but you want to look at what's the current interest rates available and what's the mortgage going to be based on that interest rate, and then what's the rent going to be. So for example, if I know that the current interest rates are 5%, then I might stress test up to higher, so 8%, 9%, to make sure that even if those rates increased, I'm still going to be netting some profit from my property. Something interesting happened back in Q1 of 2009. At that point, the inflation rate, for the first time in the history of the Bank of England, so since some 200 years or however long ago the Bank of England was originally set up and conceived, for the first time in history, in 2009, the inflation rate raised above the interest rate, and to the date of filming this, it still hasn't dropped back below. And that presents us with quite a unique opportunity, because what it means is, it also presents quite a risk, because what it means is if you've got money in the bank or cash in the bank at the moment, your cash is devaluing over time, because the likelihood that you're getting an interest rate higher than inflation is quite unlikely. So £50,000 at 10% inflation, for example, is going to leave you with equivalent purchasing power of £45,000 in a year's time. However, of course, you're going to add a little bit of interest, but you're probably not going to be adding 10% interest at the moment. On the flip side of that, if I've got, say, £1 million worth of mortgage debt and I've got a 10% inflation, so unusually high inflation, that means that the mortgage debt is actually equivalent in real terms to £900,000 in just a year's time. And now if you factor in, of course, the fact that I'm going to have to pay some interest, so let's say maybe I'm paying 5% interest on that £1 million of mortgage debt, maybe I'm going to pay 50 grand worth of interest, but the real value of the money is going to be 900,000 in a year's time. So you've got to remember that relationship between inflation and interest. The other thing we have to think about is obviously the money's not just sitting there, it's doing a couple of things. Number one, it's leveraging. So what we're doing is we're buying assets which are appreciating in value over time. So generally speaking, property tends to move 7% a year. Obviously that fluctuates. Some years it's going to be more, some years it's going to be less, but nobody should be buying property with a short-term view. Property is a long-term investment. So if we look at 10 years, 20 years, then I think we can all agree that property is going to go up. So what we're looking at is not just the fact that we've got that relationship between interest and inflation, but also looking at the fact that we've leveraged our cash, we're getting capital appreciation, and then finally thirdly, the fact that we're also going to be getting cash flow as well from the rental of that property, if it's a buy-to-let property, for example, or from the nightly bookings, if it's a service accommodation property, or whatever it is that you might be doing with that property. So a super robust way to utilize debt to build and scale your wealth. And so make sure you really get that understanding of good debt and bad debt, because too many people have this myth that they propagate about how important it is to pay off your mortgage and get yourself debt free. But if you're utilizing that cash, and that is an if you're utilizing that cash to go and generate more cash, you're treating that cash like an employee, so you're making it work for you, then that's much better off making you money elsewhere than it is just paying off your mortgage balance. So what we always have to look at is the difference. As in, let's say I paid off the money on my mortgage. Let's say I had 100 grand on my balance on my mortgage and I paid that off. Maybe it's going to save me 5%. Again, I'll use that example. It could be more, could be less. So check what's relevant right now. But let's say it saved me 5% a year. But me investing that cash elsewhere, I can get a 20% ROI, which is quite common in property when you take into account the leverage, the cash flow and everything else. Now, if I can get a 20% return on my cash elsewhere, and probably more, if I'm honest, then I'm better off having that cash elsewhere rather than having paid off my mortgage. I hope that makes sense. I just think it's so important to understand the difference between good debt and bad debt. And bad debt's super simple. Stay away from borrowing money. Don't ever borrow money to buy anything which is going to cost you money, lose you money, or go down in value. That's reckless. It's not going to get you where you want to go. It's just going to be short-term pleasure, long-term pain. But if you can understand and conquer the ability to get good debt and use it to leverage and get more cash and create more revenue, then you will be able to set yourself financially free without a shadow of a doubt. So I hope that's been useful to you. Steve Doran, let's make the rest of your life the best of your life.